So the cost of capital is the cost of using funds by creditors and owners that are provided to the company. So creating value that requires the investment in capital project that provides a return greater than the project cost of capital. So when we view the firms as a whole, the firm creates value when it provides return greater than the cost of capital. And cost of capital is the cost for the capital which is provided by capital suppliers. And the capital suppliers are creditors and the owners. So estimating the cost of capital is challenging, actually. It's not just getting the things and putting into the NPV. So to make it more clear, for example, I have here cash flows. I opened this work is, I think, Ali Bek's work I was going through. So in here, you at the end, you calculate the NPV, okay? Here's what you calculate as NPV. But in the NPV, you use rate of return, which is 18% in here, okay? But this 18%, it refers to the cost of capital. Is the cost of the capital that is provided by creditors and the owners. If your return is greater than the cost of capital, then it means that the firm is creating the value. So we will, in this chapter, we will learn how to calculate this cost of capital. It's not just getting this number and putting this 18%, okay? And we'll be able to, you will know at the end of the chapter, you will be able to find out how to calculate this cost of capital and use this cash flow in projection, okay? So estimating the cost of capital is a bit challenging. So we must estimate it because it cannot be observed and it cannot be derived directly from a ready number. So we must make a number of assumptions in order to calculate it. And for a given project, a firm's financial manager must estimate its cost of capital, and there are ways of to do it. So the cost of capital is the rate of return that suppliers of the capital, creditors and the owners require for the as compensation for their contributions as a capital for a specific project or for a specific firm. So the cost reflects the opportunity cost of the suppliers of the capital. Actually, the opportunity cost in here, it means that they could have invested in other fields. They could have invested in other alternative project, but they decided to invest in here. So that's why it should be compensated, which means that the return on from the specific project should be higher than this cost of capital. That will make the profit to work. So when you use this IRR, internal rate of return, even though it has some pitfalls, the idea of using it, it shows that return on a certain project, if it's higher than the cost of capital, then you should accept the project. This is what it implies to. So whenever you invest as an owner or creditor, you expect from a certain project a kind of compensation. That compensation is referred to return. That return should be higher than the cost of capital. So the cost reflects the opportunity cost of the suppliers. As I told you, it shows the best for given alternative projects, which means that these investors, bondholders, or the owners, they could have invested their money in a different alternative, but they invested in a certain project. So opportunity cost of investing in this project is to invest in, I don't know, in other fields. So basically, the weighted average cost of capital is the cost of raising additional capital with a weight representing the proportion of each source that financing is used. So this weighted average cost of capital is sometimes used as marginal cost of capital because it measures the additional cost for, it measures the cost for additional raised capital for a certain project, okay? And this capital is raised by creditor and owners. So this is the formulation we have it, like weighted average cost of capital, or we call like MCC, which is marginal cost of capital. It is the proportion of debt times the cost of debt, which is taxed, 1 minus tax plus proportion of preferred stock times by cost of preferred stock plus proportion of equity times by cost of equity. So in order to come up with a weighted average cost of capital, we need to all calculate this proportion times with the cost of corresponding component, okay? So the abbreviations are here and the abbreviations are interpreted in here. You can just fold up. So the example is given here. Suppose the Whitgate company has the capital structure of composed of the following in billions. So debt is 10 million, 10 billions, and common equity 40 billion. So in total, the total asset is equal to 50 billion. So if before tax cost of debt is 9%, the required rate of return is on equity is 15% and the tax rate is 30%. What is the Whitgate's weighted average cost of capital? So it's actually in here everything is given to you calculated. Now for you is just to substitute all numbers and just calculate. I mean, it seems pretty easy. However, when it comes to the reality, actually, it takes the time to calculate each proportion, each cost of equity, cost of preferred stock, and cost of debt. It actually takes the time, and there are some challenges we are facing while doing so. So we should be very careful about it. So example, what we get here, 13.25% in here, as you substitute the numbers, you just calculate it. And this is we use to calculate NPV, actually. We use this discount rate or required rate of return or cost of capital in NPV. So we can substitute this 18% by 13.25, and we can derive the real present value of future cash flows and sum it up and subtract from the cost, and you will get it net present value. So when the Whitgate company raises $1 billion more of capital, it will raise the cost capital proportion of 20% to debt and 80% equity, and its cost will be equal to 13.25%. So, and there's the tax effect, actually, the interest on debt, tax is deductible. Therefore, the cost of debt must be adjusted to reflect the deductibility. So we multiply before tax cost of debt by a factor which is 1 minus tax. That T is the marginal tax rate. So this is what we are coming up with. So if you go further here, because all the interest expenses are adjusted to tax, and there's a tax shield is coming from the interest, so we need to deduct in order to come up with the cost of capital. So the weights of the weighted average, okay? Actually, the weight of the weighted average should reflect the company will raise additional capital. Ideally, we would like to know company's target capital structure. Actually, the capital structure is what is showing you how much of your asset is financed by debt and how much of your asset is being financed by equity. Okay, this is how the capital structure looks like, and the target capital structure shows the aim. I mean the level of your capital structure, what it should be. So which is the capital structure that is company's goals, and that we cannot observe this goal. So there are alternative ways to measure it. The first one is to assess the market value of the company's capital structure components. So we'll do all the three things to examine the trends in the company's capital structure and use the capital structure of comparable companies, like weighted average of comparable capital structure. So using the marginal cost in capital budgeting and analysis, so the weighted average cost of capital is the marginal cost for additional funds, hence additional investment. So in capital budgeting, we use weighted average cost of capital adjusted for project specific risk to calculate the net present value. And using the company's overall weighted average cost of capital in evaluating the capital project, that assumes the project has similar to the average project of the companies, okay? Similar risk to average project company. So if you come up with a structure of the cost of capital is, we said, the weighted average times the cost of debt, plus, which is adjusted to tax as well, of course, plus weighted average times the cost of preferred equity. So let me just copy that formulation. Okay, this. Put it here. So you can just compare. So weighted average now. This weighted average, it measures the proportion that is multiplied by cost of debt. And it's adjusted, the cost of debt should be adjusted to the tax rate. And then proportion of preferred equity times by cost of preferred stock, cost of preferred equity here. And weighted average of equity times by cost of equity, of common equity here. But these subgroups, we can see it shows the way of calculating, is the way of estimating each cost, okay? The cost of debt is estimated through the yield to maturity or debt rating methodologies. Cost of preferred stock is estimated through the return on preferred stock or the variation because of the callability. So that sometimes we have callable preferred stock. That's why it might be changing. It's a bit tricky in here. And cost of common equity is using three methods of estimating the cost of equity. Okay, the weight of average is easy to estimate. I will show you how to do it in three ways. But estimation of the cost is of debt and preferred equity and the common equity is a bit different. Like cost of debt is measured in two ways. Cost of preferred equity is basically measured in one way, sometimes in two ways, due to callability, due to there can be callable preferred stock. And cost of common equity is estimated through three methods, which is CAPM, DDM model, and bond yield plus risk premium. So we're going to proceed through each, how to estimate. So this is kind of a schedule of this chapter, okay? In here, you will learn how to come up with this, how to estimate each cost of. So why we need to do it? We need to calculate this weighted average cost of capital, okay? This is our important point, okay? This is what we are trying to get, actually. This is our final destination. But to reach this final destination, we need to calculate the cost of preferred equity and cost of common equity and the cost of debt, okay? This is what we are trying to work on, actually. Okay, let's go with some questions. Let's go with the first question. Assume that the ABC Corporation has the following capital structure, like 30% of debt, 10% of preferred stock, and 60% of equity. So now we're working on the weighted average, okay? We're working on the weighted average of, then we will proceed. Once we are done with the calculation, with estimation of the weighted average, these proportions, then we will go with estimation of cost of debt, cost of preferred equity, and cost of common equity. This is very important. So this is information is given, and ABC Corporation wishes to maintain this proportion as it raises new funds. So it before tax cost debt was 8%, and the cost of preferred stock was 10%, and cost of equity was 15%. If the company's marginal tax rate is 14%, what is the weighted average cost of capital? So we need to calculate weighted average cost of capital is proportion times by the proportion of debt times by the cost of debt plus proportion of equity preferred stock times proportion of preferred stock times cost of preferred stock plus proportion of equity, I mean common equity, and times the cost of common equity, okay? Everything is given here. We just need to substitute. If it's proportion of debt, it says like 30% of debt, which is 0.30 times the cost of debt, which is 8%, 0.08, but it should be adjusted to the tax rate. 1 minus tax rate is 40%, and plus the proportion of the preferred stock, which is 10%, times the cost of preferred stock is 10%, times, no, it's sure I was trying to adjust it, plus proportion of whatever is remaining. It will be the proportion of the common equity, which is 0.6. I have got, okay. We'll compare. You're correct, Alibek. You're correct. Let me just, should have got this. So this times by cost of equity, which is 15%. And this all you get it 0.1144. Or if it's in term percentages, it should be 11.44%, okay? This is we're gonna use as weighted average cost of capital. Now, this is the first question. This is the main goal of this chapter, to teach you to calculate the marginal cost of capital. But this is the simple way of doing it. Like everything is provided, you just substitute and put it. But what if it's not provided and you have to derive it yourself? This is what our job, this is what our aim is, to learn how to derive it, how to get it. So go with the question 2. Financial analysis estimating the cost of capital for ZL Corporation. In the process of estimation, the Richard has estimated before tax cost of capital, deals of debt equity as 4% and 6% respectively. So what are the tax costs of debt equity if the marginal tax rate is 30 and 48%? So now we need to calculate the cost of debt with a 6 and 4%, okay? So now, if there's a tax rate, if it's 30%, we need to first of all come up with the conclusion that equity is not tax adjusted. Only what is adjusted in accordance with the tax is debt. So we need to adjust the cost of debt only, which is 6%. Or am I mistaken here? Debt and equity, sorry. Debt is 4% and equity is 6% respectively, okay? Debt is 4%, so we're adjusting only the debt. So debt is 4%, 0.04 times 1 minus 0.30. This is how we adjust it. And you will come up with, after tax cost of debt, 2.80% directly, or 0.028. And we do the same thing for 48%, 0.048. Sorry, 0.4 times 1 minus 0.48. This would give you 2.08%. So this is how the tax affects the cost of debt, okay? So we can come up with the conclusion that the higher the tax, the less we will have the cost of debt.
Sorry, I have a question.
Yes, please.
In first example, can you interpret the weighted average cost of capital? It means that 11% it's our additional investment cost, or
no? That means the raising additional investment for a certain project, the cost of it is 11.44%. That shows this is the minimum that you would go with. Actually, you will accept the project if the return on that project will be higher. Okay?
Okay.
This is what it means actually. If it goes below if the return is below this cost, then you would not accept. Okay? If you remember, I just read the definition here of the cost of capital. It says here, creating value requires the investing in a capital project that provides a return, here's the keyword, greater than the project cost of capital, okay? Our cost of capital is weighted cost of capital, weighted average of cost of capital. And this was the second question. Now we're coming to third question, but so the third question, it says that estimating the proportion of the capitals, okay? The current capital structure, the competitor's capital structure. So there are different ways of estimating the proportions of the capital structure. So that now is our job is to learn how to get the proportions, these weighted average proportions in when you multiply by the times, and the final destination is to calculate the weighted average cost of capital. So we're given, let me make it bigger. Financial is a financial analysis with analytiker firma. The ANZIL is the process of the estimating the cost of capital, and the following information is provided, okay? We're given the market value of the debt, which is 50 million, the market value of equity, which is 60 million. And primary competitors and their capital structure in millions are given here as well, okay? So we will use two methods. One method, when our capital structure is given, we'll use it. We'll try to come up with a proportion of the debt, proportion of the equity. And the second, when our competitor's capital structure is given. So what are the Gay-Witt proportion of debt and equity? They would use, if estimating the proportion, using the company's current capital structure and the competitor's capital structure, okay? And the third question, suppose the Gay-Witt announced the debt equity ratio is 0.70, reflects its target capital structure. So we will use, sometimes using the debt equity ratio. And what weight should ANZIL use to the cost of capital calculation? Okay, these are the questions. So first of all, to answer the first question, let me put it here. The current capital structure is straightforward. We'll divide the debt by total assets, then equity by total asset. And total asset is what? Is debt plus equity, actually. So weighted average of debt then equal to 50 million, 50 million. Make it like this so we can see it. 50 million divided by 110 million. Debt divided by, how did I get it? I got 50 plus 60. It's total asset. That would give me the proportion of debt, the capital structure of the debt, which is 45.5%. And the same thing, the weighted average for equity is 60 divided by 110 million. That should give me the 0.5454. These are the proportions, how we calculate it. Or this could be calculated as 1 minus WD, okay? Directly you can get this answer, the proportion. This is the first way of calculation the proportion, okay? The capital structure. And sometimes the target capital structure would be given to you. You have to use the target capital structure to calculate it, okay? The best level of the capital structure that should be achieved, actually. Now we are moving to second question. Calculate the competitor's capital structure. To calculate the competitor's capital structure for debt, we're gonna just take the average of it, okay? For A and B. So the weighted average of debt is equal to I open the big formulation. So $25 divided by 75. This is for company A, okay. I'll put the names so that you don't get lost. And plus for company B, 101 divided by, it's not a multiplication, guys, okay? A and B, it's just not to get you in a direct way, in a right way to understand. So what I'm doing with what I'm multiplying, I'm just trying to calculate the weighted average for debt using the competitor's capital structure. So this means that 101 plus 190, let me put it directly, 291 plus company C, which is 40 divided by 100. Okay, and this all should be divided by the number of the verbs that we're using, by 3. Yes, there's a question. Okay. And we would get here 0.36, the proportion for that. And how can we get the proportion for weighted average of equity? We can do the same thing, like equity divided by total asset, or we can just directly calculate like weighted equity is equal to, I just rounded numbers, okay? It's maybe 0.3059, but I just rounded to 0.36. So just don't be confused. If you try to calculate yourself, 1 minus weighted average of D. Or you can apply the same formulation. You can get the same thing, okay? 1 minus 0.136, it is 0.54. 64. These are the proportion used by competitors, okay? So this is second way of calculating it, okay? We can calculate using in this way. And there's a third way of calculating the proportion. So which way will be given to you, you will use that way, okay? So to calculate the, we are given here, what weight should Angela use as a cost of capital calculation? There's a missing part, I think. Are we given here something? Here. We are given debt to equity ratio, which means debt to equity ratio is equal to 0.70. Okay. So that represents debt over equity, 70%. Okay. That means your equity is 1. So to calculate the proportion weight on the debt, it is always, so you should keep in mind, weight of the debt is equal to, is debt divided by, sorry, debt over equity, debt equity ratio, debt equity ratio divided by 1 plus debt equity ratio. This is you will calculate. This is will let you to calculate the proportion of the debt. Okay. Then, if this is the case, we substitute 0.7 divided by 1.7. That would give you the debt equity, the proportion of the debt, which is 0.41. Calculator just for you. Okay, 0.7 divided by 1.7, 0.4118 if you round it, okay? And to calculate the proportion of equity is 1 minus proportion of debt equity, which is 1 minus 0.4118, would give us 0.50 if you subtract 15882. Okay. This is how we calculate. Okay, this is the 3 ways of calculating the proportions, okay? So whatever is given, you will go with it. If this first is given, you go with the second. If I ask you to go with the third, you would go with the third one. If this is target capital structure, okay? Wait, like they're putting the target and this is what you should follow. This should be target capital structure. And to find the proportion of the weight, then this is the formulation, you have to use it. Do you have any questions? Let me save it. Question. Actually, these things are given in the book. I'm just solving the book's example to you. And there's another example here. The Valence Industry issued bonds. Okay, this we'll come to this. We'll come to this. Okay, let's go. Let's go further. So now we learned how to calculate the weighted averages. Okay, how to calculate the proportions. That's good. Like, okay, we put aside. So before I proceed to calculate the cost of debt, cost of preferred stock, cost of common equity, please don't be hesitated to ask any questions, okay? We will not come back to it again. Okay. If company has publicly traded long-term investment and great debt, cost of debt is determined using the yield to maturity. If companies has got outstanding debt and that doesn't have a regularly, cost of debt is estimated using the average yield of similar rated debt. And if rating does not exist of the company's debt, we estimate a synthetic rating and refer to number 2 as alternative use as risk-free rate plus default spread approach. And the fourth, if the company has a speculative grade debt and the cost of debt is calculated using the CAPM model. So these are the 2 examples, like yield to maturity and debt rating approach. If these 2 are not available, we will use a synthetic one. We'll calculate, we'll rate the bank or the institution by ourselves to calculate the cost of debt. So in the first case, they consider the company that has got 100 million of debt outstanding and has got coupon rate 5% and 10 years to maturity, and it's quoted as 0.98. So what is the after-tax cost of debt? If the marginal tax rate is 4%. So assume that semi-annual interest rate is here. So the cost of debt is calculated in the semi-annual way here, and it's tax adjusted, okay? It should be always tax adjusted. So this is how they calculate. This is how you calculate the YTM. And this is, you should use the financial calculator or Excel to come up with the calculation of rate. So I will demonstrate the question to you. Face value, which is principal or outstanding debt, which is 100. The present value currently is quoted as 0.98, which is 98, okay. And but maturity is 10 years. Coupon rate is 0.05, if I'm not mistaken. 5%, okay. Now we are asked to calculate the YTM, the yield to maturity. That will give us the rate. So it's easy. It's in Excel. It's straightforward. And the same thing you can do. So this is quoted. So it's just rate. We type equal sign rate, okay. Put the number of periods, which is 10. This present value should be negative, okay. Minus present value. Always should be negative. We're discounting. It's discounted value. And payment, sorry, I missed the payment. I missed the payment. The payment is here, which is 5% times hundreds. Okay, this is the payment. And the face value, we can put it and we may not put it. Okay. You want me to repeat? Okay. So I'm erasing everything. I type rate. The number of period is 10 years. Coupon rate. So the payment is coupon rate times outstanding debt. And present values should be always negative. And the outstanding debt, which is future face value, is 100. And we close it. $5.26. But this 5.26 is subject to the tax, okay? It should be tax adjusted after tax rate. After tax rate. That means it should be this times 1 minus 0.40, if I'm not mistaken. Yeah, 40%. So your after tax rate is this. So this cost of debt, we're gonna use it, okay? So when we calculate the proportion of the debt, when we have decided with regarding the capital structure, then we have to calculate the cost of debt using the YTM methodology. Is this, okay? So YTM methodology is this. So this is how they get it, and this is cost of debt capital is this, and this then it should be multiplied with this. Okay, we found the weighted proportions, then we find the cost of debt adjusting to the tax. Okay, great. And cost of debt can be found using the YTM or debt rating, or if debt rating is not available and YTM is not available, we're going to use the synthetic approach where we estimating ourselves when we rate them by ourselves. Okay, and coming to the debt rating issue, the debt rating approach, consider the company that has got contracted 100 million of debt outstanding and that has been debt rating of AAA, double A, and the yield on AAA is currently 6.2%. So what is the after-tax cost of debt? So what do you just get this? This is the most easiest one. In here, you don't have to calculate anything. You just grab the number and adjust to the tax, and you get it. So this is another way, okay? Two ways is the most thing that you should remember. If these two ways are not available and it's not rated, then you have to rate yourself using the synthetic approach. So estimate the synthetic rating is alternative is to play a role of rating agency and assigning a rating to a firm based upon the financial ratios. And this rating is called like synthetic rating. To make the assessment, we begin with rate firms and examine the financial characteristics that share the firms within each rating class. So once synthetic rating is examined, it can be used to estimate the default spread, which can add the risk-free rate yields, like pre-tax cost of debt. Then it should be adjusted, of course. So the example is here. These are the, we can say, abbreviation of the form, the ratios that we're gonna use to rate it. Okay, the aggregate metrics by rating, like ABA, like earnings before interest tax average, divided by average assets, operating margin, the EBIT margin, EBIT over interest expense, and FFO plus interest. So these are the examples, okay, how to use the ratio to rate the, which ratio should be used to rate the agents. And this like AAA, AA, B, AA, and so on. So this is information is provided from Moody's financial metrics. Here, how the rating is done. Here's the spread that you're gonna add with the risk-free return, okay? And then you will add it. If first two methods is not available, okay? These are the third method. And I'm not going to ask from you to rate it from the beginning, but for your concern, you should keep in mind, if you will be given any projects in your real life and the YTM is not given for a certain project and it's not rated, then you should do yourself rating. You will put you stand in the role of rating agency, and these things that you will do it yourself. Okay. So far we have done with the cost of debt. Okay. Yield to maturity, debt rating. Any questions, guys? Guys, if you have got any questions, how to calculate these things you have already known. The debt rating you don't have to calculate, you just grab the number directly, and the yield to maturity calculate. But everything should be adjusted to the tax. This is what you should keep in your mind. Okay. If you don't have any questions, I want to solve this question. Now we're given question here. The Valence Industry issue bond finance a new project, and it offers 10-year, 5% semi-annual coupon bond. Upon issue, the bond sells $1,025. So what is the Valence before tax cost of debt? And the Valence marginal tax rate is 35. So it's the same thing. You're asked calculating the cost of debt using the YTM approach, okay? So everything is given to you. You can use the financial calculator or here. So I'm not going to use them. I'm just going to give you directly. The YTM is direct equal to 4.64%. This is before tax. And YTM 0.04684 times 1 minus 0.35. That would give you 0.03045 or 3.45% after tax. Okay, this is how we calculate the cost of debt using the YTM approach, or we can do it debt rating approach. Okay, coming to the cost of debt, cost of preferred stock. So it is second component of the weighted average cost of capital. It is using, actually, basically, we're calculating here perpetuity methodology, like perpetuity, why it's a perpetuity, because it's doesn't have a limited life and it's forever. And dividend divided by rate. So price is equal dividend divided by rate. And if you rearrange the formula, it's rate equal to dividend divided by price. That will give you the rate, the cost of preferred stock. And suppose the company has a preferred stock outstanding that has got dividend of $1.25 per share, and the price is $20. So what is the company's cost of preferred equity? It's just, you substitute the numbers, you just come up with this number, okay? It's just straightforward. Okay, straightforward. If it's very rare, but it happens sometimes, there is a callable preferred stock, that convertible preferred stock, that preferred stock would be converted to a common stock. And of course, that's gonna change, that will complicate the calculation of the cost of debt. So this is in your, if you face it in your real project when you're gonna do the investment appraisal, and if you're asked to calculate weighted average cost of capital, please you have to keep in mind that there's another way of calculating it, and it's going to complicate the things when it's converted to common equity. Okay, when it's the cost will be, but for simplicity, we'll assume that this will not going to have any convertible preferred stocks. So this is the way that we calculate preferred stock. And okay, so let's analyze so far what we did. The proportion, we know how to calculate using 3 methods. Then we know how to calculate how to estimate the cost of debt using the YTM and the debt rating measures. And we know how to use the cost of preferred equity is using the perpetuity methods, like dividend over rate, and we rearrange it to get the rate like dividends over the price. And we know it, and it varies, it changes, it become a bit challenging when there is like convertible preferred equity. That makes the things a little bit complicated, but we're assuming that it's not going to take the place in our projects. Now is the time to move cost of common equity. So when we finish the cost of common equity, we're going to have a big example how to calculate the weighted average cost of capital, okay? And at the end, this will be given to you as a big comprehensive exam. And guys, at the end of the book, okay, there are some questions. There are questions that you have to solve it, okay? End of the chapter, there are questions that you have to solve it. Like chapter 2 that we finished it. Here, multiple choice questions, okay? Please try to go over them as well. These multiple choice questions, try to solve them, to practice it, okay? To get your hands ready for anything to calculate, okay? These good questions, I mean, as to practice. Okay, do you have any questions? Time is over, I know. And do you have any questions? If you don't have any questions, thank you so much for your attention. See you tomorrow. But if somebody has it, please stay in the conference and ask.
Thank you. Bye.
Bye.
Thank you for the lecture. Bye.
Goodbye.
Goodbye. Have a nice day.
Goodbye.
Bye.
Bye.
Bye.